Candlestick patterns are the building blocks of price action, offering a visual representation of market psychology and the ongoing battle between buyers and sellers. They not only reveal important details about current price trends, but also help forecast potential reversals and continuation. Mastering candlestick patterns can provide traders with a clear edge, allowing for more precise entries and exits in trades. In this video, I'll walk you through the most powerful candlestick patterns that I personally rely on to gauge market sentiment and determine high-probability trading setups. We'll explore how these patterns reflect the daily movement of prices and how, when combined with trend analysis, they can enhance your overall trading strategy. Whether you're looking to go long in a bullish trend or short during bearish conditions, understanding these patterns will give you the confidence to make smarter, more calculated trading decisions. By the end of this video, you'll not only understand how to read candlesticks, but also how to apply this knowledge to improve your trade timing and enhance your success rate in the market. Let's get started. Welcome to this video on candlestick pattern. Welcome to Profitable Forex Trader. In this video, I'm going to show you some of the most powerful candlestick patterns that I use to identify high probability entry points or to complement my trades. Before we dive in, please pause the video and take a moment to read the disclaimer. Once you're ready, let's continue. When analyzing a Forex chart, we typically look at the chart to determine the probable direction of the price, whether it's in an uptrend, downtrend, or consolidation phase. However, beyond just looking at trends, we can also examine the candlestick patterns that make up the price action. These patterns provide insight into the market sentiment on a day-to-day basis, whether it's more bullish or bearish. By understanding these patterns, we can fine-tune our entries, allowing us to enter trades when all the indicators align in favor of either bullish or bearish momentum. When analyzing price charts, I prefer to use candlestick charts. These charts are composed of individual candlesticks, and you can select any time frame. Personally, I prefer using daily candles, where each candle represents one trading day. So, how do you read these candlesticks? Let's go over a quick revision for those who are new to this. Candlestick can either be bullish, often depicted as white or green, or bearish, usually shown as red or black. Let's start with a bullish candle. A bullish candle forms when the market closes higher than it opened. For instance, if the market opens at $5 and closes at $7, you get a bullish candle. The body of the candle shows the difference between the open and close prices. The bottom of the body represents the opening price, and the top represents the closing price. During the day, the price might reach a high, known as the day high, and a low, known as the day low. These are depicted by the upper and lower shadows, or wicks, on the candle. The entire length from the top of the upper shadow to the bottom of the lower shadow is called the range of the candle. Now let's talk about a bearish candle. A bearish candle forms when the market closes lower than it opened. For example, if the price opens at $5 and closes at $3, you get a bearish candle, which could be red or black. The body of the candle shows the difference between the open and close prices. And just like the bullish candle, the upper and lower shadows represent the day high and day low, respectively. The range of the candle is the length from the top of the upper shadow to the bottom of the lower shadow. It's important to remember these terms: body, shadows, and range. A bullish candle opens here and closes there, with the day high and day low represented by the shadows. A bearish candle opens here, closes lower, with its own day high and day low. When you look at charts, you'll notice that not all candlesticks look the same. Some are thicker, thinner, taller, or shorter, and these variations in the shape of the body. The shape of a candlestick, including its body and shadows, provides important insights into the underlying market sentiment, such as whether it is bearish or bullish. This information helps traders make more informed decisions. Let's break down what this means by examining specific candle patterns that are both powerful and reliable. One such pattern is the Bullish Pin Bar. In this case, all four examples are Bullish Pin Bars. They are referred to as pin bars because their appearance resembles a pin. What do they have in common? First, they all have small bodies. In some instances, like one of the examples shown, the body is virtually non-existent, because the opening and closing prices are the same, resulting in the body being just a single line. Another key feature of these candles is the long lower shadow, which makes up about 2/3 of the entire range of the candle. When these conditions are met, we have what is known as a bullish pin bar. A bullish pin bar signals a potential reversal in the market. When a downward series of candles is followed by a bullish pin bar, there is a strong likelihood that the price will reverse and start moving upward. Traders typically look to enter a long position after spotting a bullish pin bar. However, it's crucial to understand that candlestick patterns alone are not reliable unless they appear in the right context and at the right location. For a bullish pin bar to be considered reliable, it should appear at a support level. Ideally, the lower shadow should dip below this support line, which is often represented by a moving average, and the market should be in an uptrend. To summarize, a bullish pin bar has the highest probability of indicating a price increase when it appears at a support line within an uptrend. Now let's look at the opposite of a bullish pin bar, the bearish pin bar. As the name suggests, the bearish pin bar works in reverse. Just like the bullish pin bar, it has a small body or sometimes no body at all, where the opening and closing prices are nearly the same. However, what sets the bearish pin bar apart is its long upper shadow. For it to qualify as a true bearish pin bar, the upper shadow should make up about 2/3 of the entire candlestick range. For this pattern to be most effective, it needs to appear in the right context. Ideally, you'll want to see a series of candles trending upward before the bearish pin bar appears, signaling that a reversal may be on the horizon. The most reliable bearish pin bars typically show up in a downtrend, right as the price reaches a resistance level, such as a moving average or resistance line. When the upper shadow of the pin bar cuts through this resistance level, it becomes a high probability shorting opportunity. Let's break down the psychology behind this pattern. On a particular trading day, the price may open at any level. Similar to the bullish pin bar, the color of the bearish pin bar, whether it's green, red, white, or black, doesn't matter. During the day, the bulls initially push the price higher, creating the long upper shadow. However, partway through the session, the bears take control, driving the price back down by the end of the day. This sudden shift from bullish to bearish dominance suggests that the sellers have taken control, likely leading to a price drop in the following session. Now let's apply this to a real chart. Look closely at the chart and try to spot the bearish pin bar. See it? Let me draw it out for you. There it is. Notice how it appears in a downtrend, with the 50-day moving average acting as resistance. This makes it a strong signal that the price is likely to fall. So now, you've learned about both the bullish and bearish pin bars, two of my favorite and most powerful candlestick patterns. Next, we'll explore another set of key patterns, the tweezer bottoms. That wraps up our deep dive into the bullish and bearish pin bar patterns, two of the most reliable candlestick signals for spotting potential market reversals. In our next tutorial, we'll be taking a closer look at tweezer tops and tweezer bottoms, another powerful pattern for identifying turning points in both uptrends and downtrends. These patterns can be a game changer in your trading strategy, so you definitely won't want to miss it. If you found this video helpful, don't forget to hit the subscribe button and turn on notifications so you'll be the first to know when the next video drops. Be sure to like, share, and comment below with any questions or insights. I'd love to hear your thoughts and help you on your trading journey. See you in the next video.